Okay, welcome everybody. My name is Kristen Biermeyer. I'm the marketing manager at Wagner CPAs, and I'm so happy to have you all join us today for this webinar on the basics of nonprofit financial statements. Feel free to submit questions you have during the webinar today using the Q&A feature at the bottom of your screen, and we'll be sure to leave some time to answer all of your questions at the end of the webinar. This presentation is being recorded, and the presentation and slide deck will be emailed to you after today's event, as well as available on the wagnercpas.com website. Our presenter today is James Conrad, a supervisor at Wagner CPAs. And with that, James, I will turn it over to you.
Wonderful. Thank you, Kristen. Appreciate the introduction. And hello, everyone out there in the internet land. As Kristen mentioned, my name is James Conrad. I am a supervisor here at Wagner CPAs. And I'm going to be talking today about nonprofit financial statements. I imagine that many of you have questions and just are trying to unlock the puzzle that is financial statements, and I'm aiming to help you out with that. So today's learning objectives, these were outlined in the initial email. We want to identify the structure and composition of compiled nonprofit financial statements, and that word compiled has a specific meaning to it. We're going to define account groups and how they are important for the overall structure of an organization. We're going to see that some have specific structure, some have a looser structure, and we'll get into that. We're going to look at the differences between the different bases of accounting. Most of you are going to be familiar with cash and accrual, and we're going to talk about the differences here today. And we're going to look at some metrics to determine the health of an organization. You can get a lot of information from one statement or a combination of the statements in tandem, and we're going to go over some of those today. So a little about myself here. I've been with Wagner since November of 2020. I've been a nonprofit accountant specifically for the last about 8.5 years. For those of you that have seen my presentations before, accounting is not my first trade. I was a meteorologist for several years before this, but as I've mentioned before, I like a job where I have to be right instead of where I try to be right. So let's get into a few things here. What I wanted to highlight is today is meant to be an introduction. You're going to have different financial information on different financial statements from different organizations. And it's really important to contact your accounting professional, or if you have an auditor for your very specific company issues, and they can help you out with that. And as I mentioned before, every organization is going to be different. However, the basic structure of the financial statements are going to be pretty similar across the board. You're going to find the order very similar, and we're going to take a look at that in the examples. And as Krista mentioned, we're going to have a Q&A time if we have some time available here at the end, and please submit your questions to the window. Okay, so let's start way at the top. There are 4 basic financial statements for a nonprofit. We're going to start off with the statement of financial position, and that's commonly known as the balance sheet in the for-profit world. We have the statement of activities, which is analogous to the profit and loss statement in the for-profit world. We have the nonprofit specific statement of functional expenses, and everyone's favorite, the statement of cash flows. Statement of cash flows could probably have an hour-long webinar on it itself. We're going to just be taking a cursory look at it, not getting too complicated, but this statement tends to be the one where people get tripped up on the most. So I'm hoping to bring a little light to that. So you may or may not see each statement in a different level of service for the financials and how they're being created. So I have a list here of kind of least stringent to most stringent. There's uncompiled financials, which are basically just your basic financials that are not necessarily reviewed by independent authority. There's compiled, which is also known as a compilation. Those do go through a degree of review. Then there's the next step up, which is review, which is not as deep as an audit, but it is deeper than a compilation. There are additional procedures that need to be performed. And then, of course, there's the audit, which goes through all of the testing procedures and whatnot that the assurance department, either here at Wagner or other CPA firms across the country, would do. And throughout the presentation today, I'm going to have the 4 statements up just to remind everybody where we are, where we're at, and to commit them to memory. The more you see it, the more you're going to remember. So uncompiled financials, as I mentioned, they are the lowest tier of service, basically. Usually made by internal accountants, non-attesting accounting firms. They're going to be basically your management reports. And then frequently, I shouldn't say frequently, occasionally, the statement of cash flows will be omitted in a compilation, and that would be denoted in the accountant's report. Your uncompiled financials will most likely not have your statement of cash flows either. And then specific to reviews and audits, because of the additional level of review and assurance, there's always footnotes, basically important information, explanations, disclosures. They're required as part of the review and audit process. Compilations can omit those footnotes and frequently do. All right, we're going to start off here with the statement of financial position. The statement of financial position, in my opinion, gives the most information of all the statements, but you could certainly get a lot of information from the remainder of the statements. So as I mentioned before, statement of financial position is comparable to the balance sheet for for-profit companies. And what's really important to remember is that the statement of financial position is a snapshot of a point in time. The point in time is important. It is not a range. It's a specific time that there are balances in specific accounts. It's usually the end of a month, a quarter, or a fiscal year, or a calendar year, if you're on that. And it follows the basic accounting equation, which is assets equals liabilities plus equity. Now, those of you familiar with for-profit statements, equity is presented as net assets on nonprofit financial statements. There's no ownership for nonprofits. That's one of the purposes of nonprofits, that there are no shareholders. There are the structure has a board that has oversight with the either executive director, CEO, something to that effect. Structure can vary from company to company, but it's important to know net assets is pretty equivalent to equity. So in America, there are specific sets of rules and regulations that financial statements should follow. If you've heard of it, GAAP, generally accepted accounting principles, which uses the accrual method of accounting. So that means when revenue or expenses have been earned or incurred, that's when they are put on the statements, not necessarily when cash exchanges hands. There are transactions where when cash exchanges hands, that would also be on the books. But then for other transactions, if cash doesn't change hands, doesn't need to be on the books, that's something we look into. And then frequently when you see financials, the nonprofit financial statements in general, but specifically the statement of position, you're going to have comparisons to a prior period, and that's really important to see. It gives you trend analysis. You'll be able to see what happened in the past. Is the company shrinking, growing? Usually, for example, in this example on the screen, it's comparing year to year, and frequently that is what you're going to see in audits. All right. So at the very top of the statement of financial position, you're going to get the assets section. And simply put, assets are what the organization owns. It's things that the company has gathered over time as part of its resources. So off the The assets will be listed from most liquid to least liquid. And when I say liquid, liquidity is the ability to be converted into cash. Obviously, cash and cash equivalents are going to be as liquid as you can get because by definition. However, for an example, a piece of stock is more liquid than a piece of land. It takes longer to sell land than it would be to sell stock. So when you're looking at the order of the assets, that is an important factor. And then with additional classifications, not necessarily all financial statements are going to have this, but often you will see a categorization between current and long-term assets. So current assets are expected to be used or utilized within 1 year. But long-term is the opposite of that. It's meant to be over 1 year. So let's look at current assets first. As I mentioned, liquidity, they're the most liquid and they often have the highest churn. You're going to have, for example, accounts receivable in current assets. And you expect your customers to pay you often, to pay you, have a zero balance, do more business for them, and it just continuously cycles through. The current assets reflect the state of the company right now. I mentioned before that they're expected to be used or utilized within 1 year. It's kind of a state of play. So cash obviously is going to be most liquid at the top. Cash is king. We've all heard that statement before. And for most nonprofits, it's true. If you need cash to pay the bills, your employees, basically anything you can think of. And if you don't have the cash, you're in big trouble. And then also in current assets, we have investments. If you're fortunate enough to have a surplus or an excess of cash, you can have stocks, bonds, other publicly traded instruments. Frequently, you will see surpluses invested here, maybe to make a little, make interest or a little more than interest if the market is having a good time. And again, if your company is fortunate for that, thumbs up. Also in current assets, accounts receivable, when you've either made sales or you've provided services, it's what your customers owe you. So as I mentioned before, with the accrual basis, you'll have transactions that have occurred, but cash hasn't exchanged hands. Meaning, for example, you sold product to your customer, however, you have not received cash for it. That's where accounts receivable comes in. On the cash basis, if you didn't get the money, the transaction didn't happen. So you're not going to see accounts receivable on the cash basis. Frequently, if you have a diverse enough set of business operations, you can have different subdivisions of accounts receivable. You'll have contributions receivable, grants receivable. Often I'll see accounts receivable for fee for service or program services. It helps delineate the different types of operations that your company would have. And you may also have an account that's called the allowance for doubtful accounts. It's related to bad debt. And if you have customers that just don't pay you and it happens on a regular basis, it may be where you have an allowance for doubtful accounts. If you happen to write off frequently 10% of your receivables per year, the allowance will have that just sitting there ready to be used. Also in current assets is prepaid expenses. It's paying for an item to be used later. The best example I'm always going to have is annual insurance policies. If you pay for insurance for a full year, you chop it up into 12 equal segments, and then that's your expense per month. You'll also have things like down payments for event venues. So if you're going to have a gala and you want to reserve, for example, here in Madison, the Monona Terrace, you get a convention room. If you pay up front, that's where your transaction is going to be stored. And it does follow the current versus long-term rules. For example, those down payments, you could have to reserve well in advance. And then there's a couple of handful of assorted other current assets. Employee advances, if you give your employee basically a loan up front on their payroll, accrued interest that you would get that you are meant to receive, or for some companies, if you have related entities, you'll have due from in this situation, where if the related entity owes you some funds, that's where it's stored. So now we're going to switch over to long-term assets. So this is the less liquid, lower churn section of the assets. It's long-term. It's going to be usually big purchases, investments for longer than 1 year. And when you think big purchases, you're going to think land, property, and equipment. And then now, new for 2022, the right of use asset. Some of you out there who have seen newer editions of financial statements, if you're on a slightly different fiscal year, there is a new standard that has been issued for how financials are meant to be presented. It's called ASC 842. We commonly call it internally the lease standard. There's a different way that leases are being presented on financial statements, and it'll be in your long-term assets. So part of long-term, if you break it down a little further, we're going to have fixed and intangible assets. You're probably most familiar with fixed to start. So we're talking property, plant, and equipment, land, but also for your intangible assets, intellectual property and patents or rights of use to different works, copyright, things like that. Along with that, with those items, you're either going to have depreciation or amortization. And in that section, it'll be the accumulated portions. Depreciation and amortization is basically thinking of it as using up a big asset. You're spreading out the cost that you laid out up front over the useful life of the item. So if you have a truck, you expect your truck to last you 10 years, you're spreading the cost of that truck out over 10 years. There's no depreciation on land. So land just sits on the books. It does not get adjusted for market adjustments or anything like that. Just sits at the purchase price. And the difference between depreciation and amortization is tangibility. Can you touch it? If you can touch it, it's going to be depreciated. If it's something like a patent, it's not really a solid matter that's intangible, it's going to be amortized. So can you touch it is the rule. And then most, if not all, organizations are going to have a capitalization policy they need to follow, and it's usually a dollar value. So in order for something to be placed into fixed assets, for example, if you buy a copier, but it was only $500, it's small enough to be turned into an expense immediately. But if it's over a certain dollar value, and I frequently see $2,500, at that point, it becomes a fixed asset, and then we talk about depreciation. Okay, so now that we've gone through the assets, it's time to talk about liabilities, or what you owe to other places. So just like the assets, it's going to go from most liquid to least liquid. It's a little different to think of a liability, what you owe, as liquid, but what is likely to be paid first is another way to think it. We'll also have splits into current and long-term if it's presented that way. But what additional wrinkle and complication is that you can have liabilities that are both current and long-term. So looking at your current liabilities, we're going to start off with just accounts payable, much like accounts receivable. If you received product that that was from a vendor, you owe that vendor some money, some cash to pay for it, and that's where this is stored. So it's bills to pay. This is your everyday operations. One wrinkle that some people miss is credit cards. Credit cards are technically accounts payable. You bought something on credit. And credit card transactions do exist on the cash basis because cash technically changed hands. It exchanged hands from the credit card company to the vendor, and now you owe the credit card company. So you will see credit card liabilities on cash basis reports. We also have just accrued expenses. Payday hasn't hit yet, but employees have worked and you owe them the wages that they've earned. Same thing with payroll taxes, your FICA, your SUDA, not FUTA, it's SUDA, and unemployment. And then, as mentioned before, we had the due from related entity. This would be where the due to related entity would be if you owe the other company some funds. And then we're going to talk about deferred revenue a little bit here. So deferred revenue is money that you've received in, but you haven't earned it yet. So it's almost the flip side of prepaid expenses. A wrinkle here as well is it's for exchange transactions and not contributions. So I'm going to take a little sidebar here and go over what that means. Exchange transactions are for services. You are getting reciprocal benefit to who is paying you. Whereas a contribution is money is basically going one way and they're not expecting anything in return. If there's something meant to be delivered in return, that is the exchange transaction, and the handling of the revenue recognition is different. Again, don't want to get too deep in the weeds there, but just remember, if you see deferred revenue, it's important to look for fee-for-service exchange transactions. And then, as I mentioned before, we could have the split between current and long-term for the same item. So here we have the current portions of long-term debt. So this is the part of your mortgage or your loan that you're going to, the principal portion that you're going to pay in the within the year. So it's anything that's going to be due within the 12-month period. Also part of the leases, you're going to have current portion of long-term leases with the new lease standard. And then long-term liabilities, we're thinking more than 1 year. So the actual mortgage itself, when it is initiated, it's a long-term liability. Loans, lines of credit, things that are basically long-term debt instruments. And then the leases that are taken out. If you have a lease on a building that's meant to go for 5 years, there you go, long-term liability. Okay. So the final section of the statement of position is going to be your net assets, or as we've discussed before, equity. It's what's left over if you take all of your assets and then covered all of your liabilities. So if you think home equity loans, you're borrowing against what you've already paid on your house compared to the value of it. Same thing here. If you paid all of your liabilities off, what's left? Now we have 2 major categories here. It originally was 3 categories. Several years ago, this was reduced down to 2 to make things simpler. First off, we have with donor restriction, and then second, we have without donor restriction. So the way to think about this is, imagine you're a donor and you want your donation to go to a specific program or purpose, or you want it to go to an event that's going to be held. That's going to be your with donor restriction. So if you have a capital campaign, it's meant to pay for a new building. The one I always go back to with my church background that I've worked with, the church flower fund. If you have altar flowers that are purchased on a regular basis, people want to buy those. That's a with donor restriction donation. And if you've heard of them, think of like Harvard University has a very large endowment. It's meant to be held in perpetuity, and we're going to get to that in a little bit, but it's meant for something specific. So within the with donor restrictions, we have 3 subdivisions. We have restriction with donor restriction for purpose, with donor restriction for time, or permanently. So a donation can be a mix of all three. If it's for purpose, that's like the church flower fund. Now, if you have something that's restricted for time, if you're giving a large donation that you want to have used at later periods, say you're giving $100,000 and you want it to be used up over 5 years, there's a restriction for time in there. Or permanently, you don't want the company to be able to touch that donation ever. And it sounds strange, but I have an example coming up. Permanent restrictions are just that. They're permanent. There are caveats to that. Again, not going to get too deep on that, but when you think permanent, just keep it in mind, it's permanent. Permanent restricted donations are gifts that are meant to generate more funds. So when we were talking about the endowment, if you donate, for example, $100,000 to the endowment, that can either accrue interest in the bank and the company can use that interest for programming, or you donate your 1,000 shares of Microsoft stock. It's not meant to be sold, but the dividends that get issued with that on a quarterly basis can be used for operations, but those also can be restricted too. It just depends on the structure of the restriction at the point of donation. So we could get deeper on that. Don't want to get too deep into it now, but know that that's available. Donor restrictions are binding agreements. It's basically a contract that gets set up. And if your organization does not follow through on that restriction, the donor has recourse to get it back. And on the flip side of that, a nonprofit can refuse a donation. It's strange because most nonprofits want to have all of the funding they can come in. But if it doesn't fit your mission or fit the scope of what you're trying to do, a thanks but no thanks is okay. If you refuse it because you can't fulfill the restriction, if you're a church and there's funds that are meant to go to non-religious functions or things that don't agree with the religious beliefs, it's okay to say no. And then something that I'm just going to touch on here, the permanently restricted contributions, donations can go underwater. So imagine when I mentioned that Microsoft stock, if the price of the Microsoft stock goes down, it depreciates in value because of the market. You have less stock than the original contribution, and that's underwater. There's a special presentation for that. And whenever there's market downturns, I usually have to look up and remember how to do that. All right, so without donor restriction. So net assets that have been earned without encumbrance, or the donor restriction that you originally had, either purpose, time, it was fulfilled, and now it's without donor restriction. You earned it. These net assets can be used for any activity, used for operation. It's your surplus, more or less. You can have internal restrictions. So imagine that your board wants to set aside $30,000 to make renovations to your office. That can be a motion during the board meeting, taken to a vote and approved. It is still without donor restriction. That would be that portion that they vote on would become board restricted. There. But it's really important for boards not to over restrict. It could really hamstring what the employees are doing and trying to accomplish. Okay, so I started off at the top with some metrics, things that we can think of and utilize when we're looking at these financial statements. The one that is the simplest to use is cash versus current liabilities. Is there enough cash in the bank to cover the bills that are going to be paid shortly? And then compare the amount of debt to net assets. Is there a lot of debt, or is the company just over leveraged when it comes to debt? So much is owed to so many places, but there isn't much to show for it. That can be a big red flag. Accounts receivable versus cash. That is a metric of collections. Are you able to turn over your accounts receivable and convert that into cash by getting money in the door from your customers? Low cash and high inventory. Are you not able to sell? Now, there are nonprofits that do have sales. If you're constantly dealing with inventory and an inventory glut, and you're not selling it, it's hard to get money in the door. And then on the upcoming statement of activities, you can combo some of the information that's on the statement of activities with the statement of position and get additional metrics. All right, so there was a lot of information on the statement of position. As I mentioned, that there is a lot that I like to look at on there, a lot of good information about that point in time about a company. But right now, this and then the following statements are going to be time ranges that apply to that point in time on the statement of position. We're going to start with the statement of activities. So as I mentioned off the top, it's comparable to a profit and loss statement in the for-profit world. It's going to show revenues and expenses, and it's going to show a range of time, not a point like the statement of position. It's usually a quarter or a month or a year, something that applies to that statement of position. As I mentioned, it shows revenue and expenses, and I'm going to always say this in pretty much every presentation that I make, nonprofits should still make a profit. It doesn't mean you're never going to make a profit. It's not for profit. You're not going to be dispersing those profits to shareholders or owners or anybody like that. Nonprofits need to have a surplus for either rainy days or expanding operations. But also important to know is that some activities can result in income tax. If you've heard of the unrelated business income tax, it's something to watch out for, and we're going to talk about examples of that coming up. So the activities on the statement of activities, the things that generate the revenue and expense, may be classified as with or without donor restrictions, or you'll also possibly see it restricted versus unrestricted. And then the same thing with the statement of activities using the accrual method and following GAAP, just like the statement of position. And keep that in mind when you're looking through these forms. So we're going to start with the revenue section here. So revenue, just like in a for-profit company, what an organization earns from doing business. So for nonprofits, you're going to see a nice variety of revenue streams, contributions, just donations from either regular people or corporations, government, what have you. Grants, similar to that. Usually grant has an application aspect to it as opposed to a contribution, which can be solicited, but it has an unsolicited aspect to it. Services, where you have that exchange transaction that I mentioned before. A government entity can basically subcontract to your organization to provide services, and they will pay you. Membership dues, if you have something like a chamber of commerce or an enthusiast club or something to that effect. Membership dues to be part of the club, that's revenue. And then fundraising, we all think of the big gala party that is a fundraiser with the $5,000 tables, and we have just the bake sales, even something smaller like that. All of those can be classified as fundraising. So you can have revenue that is from non-mission based activities. And when I say non-mission based, think of your mission statement that your company is designed to work under. I go back to my church example. So a church has services either Saturday, Sunday, combination of both, something like that. But during the rest of the week, they have prime real estate, specifically a parking lot that is empty. That parking lot, you can make some money by leasing out the parking spaces. But a church is not a parking spot company, it is a church. So you are competing with for-profit entities in that regard. It's not part of your mission. So income tax is going to come from something like that. Another example would be if you have an arts organization and you have this building where it's meant to be an art studio, you have easels and pottery wheels and everything set up. You can clear all of that out. And on the weekend when you're closed and you're not giving any classes, you rent it out as a party room. Well, you're not a party room company, you're a art studio. So that can run afoul of unrelated income tax as well. And then near the bottom of these classified statements of activity, you're going to have net assets released from restriction. It's going to net to zero. You're going to see in the total section, it's going to have a zero, and the canceling numbers in the two columns. Excuse me. You're going to take your current and prior year restricted contributions or any other restricted revenue, and it's going to shift it to unrestricted. So you can often have a total revenue of a negative number in this section. In this example, we don't have negative. They have received more contributions in the current year than has been released from restriction. But it is okay if that column is below zero. All right, going to the expense section. Expenses are just simple as what you spend doing business. You need supplies, you need workers, you need to spend money to make money, basically. Now, this is a section of the financials that could vary significantly between your different organizations. In this example here, we have lower detail but larger bucket classifications. But when I say higher detail with smaller buckets, we're going down to just personnel or just office supplies, just program supplies. It expands on the type of expenses. The reason for the ability of this is that you can get additional detail on the next statement, the statement of functional expenses, and shrink down the statement of activities to be a little bit more digestible. There's not necessarily a right or wrong on this format. I personally like having additional detail in the expense section, but it can be presented in this downgraded, condensed format. In your very lowest detail, you're going to have three big buckets: program expenses, management and general expenses, also known as admin. I use the term pretty interchangeably. If I say admin, I'm meaning this section. And then fundraising expenses, the expenses that you spend on your big gala or something to that effect. And then you don't see it often. You will have the other revenue and expenses. And I compare it to the other comprehensive income section. If you've seen that on for-profit statements, it's going to be things that are non-operating activities, gains and loss on stock. If you sold property and it appreciated in value from what you had it on the books, investment earnings, things that are not really underneath the purview of the organization. It's still earnings or it's still losses, and it needs to be shown, but your core business is usually above this section. Okay, so at the very bottom, we have a section for the change in net assets. So you take your revenue, you take out your expenses, and you have a surplus or a deficit at the end of the year. Did you make money? Did you lose money? And this section is the reconciliation. So you take your net assets at the beginning of the year, you factor in your change in net assets, and it gives you the amount that is on your statement of position. So you'll notice here that the columns have matching numbers on the statement of position. And that's how the statement of activities relates to the statement of position. It flows through. It takes your activities and flows through to your point in time. All right. So metrics on the statement of activities. We have the simply the change in net assets. You know, what's your bottom line? Did you make money, lose money? Specific revenue to total revenue. If you're a membership organization, for example, was your membership really good? Was your membership poor? Are you heavily grant-based? How diversified is your revenue? Something to look at there. Same thing with expenses. Is personnel your largest expense? Spoiler alert, it probably is. And you should keep an eye on that. Or are you spending less on personnel and more on contractors? Is that something that should be brought in-house? Something to look at there. Restricted versus unrestricted revenue. If you're heavily into restricted revenue, you could be limited in some of the activities that can be performed, because again, as I mentioned earlier, there is that that donor restriction is binding. So having contributions or funding that is unrestricted that can be used for anything is important. And then a really nice one that I like to use pretty much on every company I work with is the days or months cash on hand. I really hope it's months for your company. Take your total cash from the very beginning of the statement of financial position, divide by your total expenses in that time period. How many days or months do you have? I like to see, excuse me, 3 to 6 months cash on hand. That's a really healthy reserve. Some companies just do not have that luxury. It can get down to less than 1 month, and that's where I say the days cash on hand. It just depends on the structure. It could be your company is tighter in that regard, and that may be okay, but it's really good to have that reserve available. So we're going to move on to the statement of functional expenses here. We saw some of the activity in the statement of activities, but this is where you're going to get that extra detail if you have the condensed big buckets, so to speak. So this is a unique nonprofit statement, and you're going to be breaking down just the expense section into what is called the expenses function and its natural category. And we're going to get into that here in a second. And it really breaks down where you're spending the most and how you're spending it. So for these, you're going to have a function acting as the column. So it's going to be breaking down those, the buckets, the big buckets we had before, the program expenses, which are what you spend on fulfilling your mission, the management in general, which is work that's meant for the business, but it's not necessarily programmatic. It's going to be your billing. It's going to be your when you have to fill out grant reports, if you have to cut checks, anything like that. That it's all stuff that needs to be done, but it doesn't exactly one-to-one correlate with the program. And then you have your fundraising expenses. So that could be your general solicitation if you have mailers, or event-based if you're putting specific programming together for a gala. Capital campaign mailers and going out and soliciting, that's a perfect example of a fundraising expense. So when we go to function, you're grouping by purpose. And usually it's in the columns. You can have it where it's organized differently. This format that I'm showing here for this example is the most common you're going to see. And then you can break out your programs and you have your individual programs laid out if you want to present it that way, and then have a roll-up column at the end. Same thing with the fundraising events. If you have multiple fundraising events in one year, you can expand your fundraising column and show those events. So now we're going to get to the natural classifications. So this is going to be your rows. So the way I have it defined is it's grouping by the economic benefit received. You think to yourself, what does that mean? Another way to think about it is it's describing what the expenses are and not what they're for. Another way to think about it, because it's trying to define it is kind of difficult. What would it be called anywhere else? So salaries, that's a common expense across the board. Everyone's going to know what salaries are. Rent, everyone's going to know what rent is. Everyone's seen that. If you have a line that says supplies for Joe, what is that? Who is Joe? What does Joe do? We don't know. You want to make it where it's more ubiquitous, industry standard information. And like I said, this is usually your rows. You can, like I said, you can rearrange these, but this is going to be your most common format. So why? Why the functional? Why are we even including something like this? I know when I donate to a nonprofit, I like to know where my money goes. And for most people out there, where do you want your money to go? Programming. You want it to go to fulfill the mission. You feel strongly about the mission and you want it to go there. But I also consider the administrative costs. Being that I deal with nonprofits on a regular basis, there is administrative compliance costs, things like getting an audit. There could be too much admin. You could be just spending it on whatever, and it just doesn't make an impact in the community. But you can have too little admin as well. And it really has a sweet spot involved. Many grants have a cap on the amount of admin and general expenses you can make on the grant. And if you don't have the ability to get that admin cost, it's really hard to scale and expand your business, because there's definitely an ebb and flow when it comes to programmatic versus admin. Okay, metrics on the statement of functional expenses is pretty standard. You're going to have that comparison of the program to admin to fundraising. It's a ratio that you're going to see. My very basic starting point is going to be 75% program, 20% admin, 5% fundraising. But again, your organization is going to be different. It's just a starting place where I start when I'm just introduced to a organization for the first time. So I did pull some information from the latest 990s of a couple of famous nonprofits. So I started with the Red Cross. Red Cross is very program based. They have a 90% to 3% admin to 7% fundraising. So very, very programmatic. Feeding America, the hunger elimination organization, even more program based, 99% programmatic. That's very incredible. And then the ASPCA, and we see their commercials frequently on TV, and their advertising reflects it, where they have that 19%. And then 77% is your programmatic. And then now we get to the fun part. We get to wrap it up with the statement of cash flows, everyone's most favorite financial statement. Okay, statement of cash flows, just that. It shows the changes in cash from sources and uses. So you're going to have cash in and you're going to have cash out. This report really helps reconcile between the cash basis and the accrual basis. It shows you your changes in your statement of financial position accounts and how they affect cash. And it can be incredibly useful for companies that their operations seem to be a little bit more difficult to understand. There's two different versions. There's the direct and indirect method of creating this report. The direct only utilizes the cash transactions. The indirect starts with net income and adjusts for non-cash transactions and changes on the statement of position. I don't want to really have to go back and forth between these two. So I'm going to be focusing on the indirect method today. It's the most widely used out there in the wild, so to speak. So let's focus on the one that's used the most. So with the indirect method, we're going to have the changes of cash broken down into 3 types: operating, investing, and financing activities. So starting with operating activities, with the indirect method, you start with the change in net assets. We saw that on the statement of activities earlier. So we're going to be taking that number straight from there. Immediately after that, we're going to have a reconciliation. So we're going to take non-cash transactions. And in my example that I have here, some of the transactions that are listed are depreciation, deferred income tax, realized gains and losses. They're not necessarily, they're important. They affect change in net assets, but they don't affect cash. And that's something that has to be basically pulled out, backed out of that change in net assets. So we have the cash portion of the change in net assets. And then after those are pulled out in the operating section, we're just going to have the changes in operating assets and liabilities. So your accounts receivable, your accounts payable, your prepaids, all those things that we saw on the statement of financial position, we're going to be factoring in here. So got our change in net assets for operating. We have that reconciliation of most commonly non-cash transactions. So things like depreciation, gain and loss, deferred income tax, if you have the unrelated business income tax. We really need to back out those. We need to back those out to get that cash affecting portion of the activities. And then our changes in operating assets and liabilities, receivables, prepaids, inventory, etc. So kind of a global look at operating activities. The cash in and out changes here can be confusing. And these 4 points will help you when you're looking at a statement of cash flows. If the asset goes up, it's an outflow of cash. If the assets go down, it's an inflow of cash. And then it's the reverse for liabilities. If liabilities go up, it's inflow. If liabilities go down, it's an outflow. Well, okay, that's still pretty confusing to some. So I broke it down a little further. If you have more assets, your assets increased, your cash payments went out. You bought some things. You bought prepay insurance, or you gave out services, but you haven't been paid for them yet. You paid people to perform those services. That's cash out. And then more liabilities means you didn't pay cash yet. So you bought supplies, but it was on your credit card. You didn't pay for them yet. That's money that you still hold. It's an inflow. Or you haven't paid your employees yet because it's not payday, but they've earned their wages. You still owe that money. That's still an inflow. That's going to be your linchpin. That's going to be probably the hardest part of this statement, is understanding how cash is affected by operation or the operating assets and liabilities. Less frequently, you're going to see investing activities, so your purchases of investments, but more frequently, you're going to see the purchases of fixed assets, but not the gain and loss. We're talking you purchased a building, purchased land, purchased vehicles, those big things we were talking about. Could even be a business acquisition in there if companies merged. You're unlikely to see that very often for the nonprofit side. You're going to certainly see it more on the for-profit side, but just as an example. And then for financing activities, it really has much to do with taking out and paying back loans. When you're getting those mortgages, you're paying back the mortgage, notes, lines of credit. That's financing activities. So what would happen to cash? Did you buy something? Did you sell something? How does that affect cash? Think about what action you're performing And if it was strictly a cash transaction, what would happen? If you took out a loan, that's money in. If you're paying a loan back, you're sending it back out again. If you're purchasing supplies, that's money out. Think about how cash would be affected if it's a cash transaction. And at the very end of the statement, once you get your operating, investing, and financing activities, you're going to have a reconciliation with the beginning of the year cash, all of the changes that came from the 3 buckets, and then those 2 items summed together should give you your end of year cash. And you will have some supplemental information here at the bottom. It really depends on the situation of your organization to determine if that's necessary. So the metrics for the statement of cash flows, obviously the most basic one is ending cash. Did it go up? Why did it go up? You really want to see if the cash was generated through operating activities. So if you're just burning cash left and right because you have way too many employees, or you're just not generating any sort of positive activities, that's just a big red flag for any organization. You're going to run out of cash. Or if you're over leveraged on debt, things where you're just sending money out the door, even just for principal repayments, and you're having a hard time covering those, that's obviously another red flag. So we made it through the 4 statements. We're going to just take a little step back and do a review here. So as I mentioned before, the statement of financial position is that point in time, whereas the remainder of the financial statements are going to be some sort of equivalent time period that includes that point of time. The accounts on all of the statements are grouped by type or time period, or omitted entirely, because as I mentioned before, accounts receivable, accounts payable, those may not be on there if you're using the cash basis. And then, as we saw before, there are multiple metrics on each of the financial statements that you can use to get a little more in-depth with the financial information that's being presented. We have reached the end, and it is 1:57, perfect amount of time. So now I'm going to take a look at the Q&A here, and just move on to there. Turn off my laser pointer so I'm not pausing that. Okay, and I have our questions and answers here. From Jeannie Hansen, should software purchases be reported as intellectual property? Good question. The software, let me back up, is that it depends first on if it's a big purchase or not. If it's a big purchase, odds are you're going to be depreciating it. It's not going to be intellectual property because you're not owning the rights to it, you're licensing it. And that's one I would have to double check on, because you could manage to say that there is a tangible element to software because it goes onto a computer, which you can touch. I'd have to double check on that one. Kevin Edberg, how and when should donor restrictions be documented? That is an excellent question. Donor restrictions should be acknowledged at the immediate time of donation. So if you're following the IRS rules, you're going to be sending out those donor letters. That's a perfect time to say that you said your donation was for XYZ program, and that's out there. Frequently, if your accounting software doesn't have a specific module to track those, you can track those in an Excel document. As long as you are fulfilling those obligations at some point, if there's a time term on there, or it's just over the course of a program. Just making sure that you fulfill those things and you're good to go. And then the final question here from Anna, what software do you recommend? Depends on what software you're asking about. Internally, we'll use either QuickBooks or Sage Intacct. Intacct is much more robust when it comes to nonprofit reporting and the ability to track projects and restricted funds. But you can, I would say once your company scales to a large enough size, you're going to want a more robust software. And then, as Kristen mentioned earlier, the slides are going to be shared. I'm going to be sending them over to her here in a little bit. And Kristen will also have the recording, but I know either later today or sometime this week, the recording of this webinar will be on the YouTube page for Wagner CPAs, so keep an eye out there. So Kristen, I think that wraps it up for me.
All right, great. Thank you, James, for sharing your expertise today. And thank you, everybody, for joining us. We hope you found this information helpful. As James said, I'll be sending out an email with a link to the recording and the slide deck, so you'll get all that from me a little bit later today or tomorrow. Just a reminder that we have some great trainings coming up for nonprofits. Understanding the IRS Form 990 for executives is coming up next Wednesday. And we have a QuickBooks users group for nonprofits on March 29th, among many other offerings. And all of that information is available on our website at wagnercpas.com under upcoming events. Thanks again, everybody. We hope to see you all again very soon. Have a great day.
Bye, everybody.